sale and lease back. So still on the Lessee Accounting, we want to look at the concept of sale and lease back. Now, if you remember from your financial management class, you realize that one of the sources of funding for a company is what? Sale and lease back. So this is where one entity transfers an asset to another entity, and that entity leases back the asset to what? The original seller. So that now that original seller becomes the lessee, okay, and then the person who bought it, the other entity, becomes what? The lessor. So like the buyer becomes the lessor. Do you get a picture? So one entity who is selling the asset sells it, and they arrange the deal in such a way that the seller will now what? Lease the asset again. So the seller becomes the lessee, and then the buyer becomes what? The lessor. Now, it is stated that this transaction should be accounted for in accordance with what? IFRS 16. But before we go deeper into how it should be accounted for, the standard says we must ask ourselves whether performance obligation is satisfied as per IFRS 15. That's why we said these two guys are together. Yeah. You know, under IFRS 15, you only recognize revenue when the performance obligation is what? Satisfied. So the standard says that before we can say, oh, it is a sale, then we must ask ourselves, has the performance obligation been transferred? Why is this important? Because if the ownership of the asset is not given to the buyer, then that arrangement is a financial arrangement, which means it is a loan they have taken from them and they use the asset as a collateral facility. Yeah. But if they've given them the ownership of the asset, that means what? It is actually a sale. Are you getting the picture? So let's look at the rules about how this two happen. So before we decide whether it is a sale or, so it means two things can happen here. Whether the deal is a sale, the transfer is a sale, or it's a financial arrangement. In a financial arrangement, ownership is not transferred. So the money is given to them, then they will still be recognizing the asset. But if it is a sale, the seller will de-recognize the asset, and then the buyer will now what? Recognize the assets. And the lease arrangement will be accounted for in accordance with what? IFRS 16. So let's get the rules down. So A, if the transfer is not a sale, if the transfer is not a sale, then the rules below applies. If the transfer is not a sale, these rules apply. These rules apply. So on one side, you have the seller, who again is the lessee. And then on the other side, we have a buyer who becomes a lessor. So if the deal is not a sale, what do we do? If it is not a sale, then that means it is what? A financial arrangement. So if it is a financial arrangement, what does the seller or the lessee do? The seller or lessee continue to recognize the assets, but he must also recognize the financial liability. Recognize financial liability. Which in this case is the what? Proceeds. That's it. So it is not a sale. So it is a financial arrangement. Since it is a financial arrangement, the buyer, who is now, so the buyer, not like he has not bought it, but we see him as the buyer now, he does not recognize any assets because he doesn't have ownership. The only thing he recognizes is a financial asset. I hope you get a difference.
Yeah.
So if it is not a sale, it is a financial arrangement. Once it is a financial arrangement, I will continue to recognize my assets in my book in accordance with whatever standard I'm using. Either IAS 16 for business purposes or IAS 40 for rental purposes. But I must recognize a financial liability, which is the proceeds, how much you gave me for what? The deal. So since you did not buy it, you cannot recognize what? An asset. The only thing you can recognize is the proceeds. That is the money you gave to me as a financial asset. The second one, B. What if it's a sale? So if the transfer is a sale, then the following rules will apply. If the transfer is a sale, then the following rule will apply. So once it is a sale, can the seller continue to recognize the asset?
No.
He cannot. So what do? We de-recognize the asset. So the seller, number one, de-recognize the asset. That's the first thing. Because of that, the buyer now can what? Recognize the asset. Then, since he is de-recognizing the asset, how does he recognize the asset? He must then recognize the sale at fair value. So how much money he is receiving from the deal, he recognizes it at fair value. But then at the same time, even though the asset is sold, he has leased the asset. So he will recognize a lease liability. Recognize a lease liability. Then he will recognize right of use. This is what is very, very important if the deal is a sale. He will recognize right of use, which is equal to the percentage retained. This is very, very important. So recognize right of use as a proportion of previous, no, I can't. Something that thing below. Let me put it here. So recognize right of use as a proportion of, I'm continuing that line here.
Yes.
As a proportion of previous carrying value of the underlying assets. This is the workings we'll be doing, and you've got to make sure you get it. Traditionally, we would have just recognized lease liability and recognized what? A right of use. But if it deals or it goes into sale and leaseback, and the company sells the assets, then the right of use they will recognize will be the proportion of the previous carrying value of what? The underlying assets that the company has retained. Then the last thing, so the fifth one under the seller, is that he recognizes gain or loss on rights transferred. To the buyer. He recognizes gain or loss on rights transfer to the buyer. Then, what does the buyer do? After recognizing the asset, the buyer will apply the lessee accounting. The way he would have accounted for it if he had just leased his own asset. So he applies the lessee accounting. Now, what is the meaning of these two things? This is what we mean. So, there is a schedule that we're going to be doing. On one side, there's going to be a fair value of the assets. On the other side, there is going to be the carrying value on the assets. Then we're going to have two things. We're going to have the right of use retained by the company, and then the right of use transferred. Then we have a percentage in the middle. So the fair value, the total proceed we got from the sale is what will come here. Then derecognize the asset. We derecognize the asset at its what? Carrying value. So how much is left in the book? That total is what comes here. Are you getting the difference? Proceeds we had comes under the total fair value. The carrying value at which we derecognize the asset will come at the carrying value. Then the right of use retained is going to be the how do we call it? The minimum lease that we are going to be what? Paid. So if, for instance, we are now going to be leasing the asset and we pay 5,000 every month, the present value of the minimum lease payment, which we will do workings for, that is what comes in. So the balancing figure between the lease present value of the lease payment and the fair value is what? The rights that we transferred. Then we will do a percentage of that. So this divided by this times 100 will be brought here. This divided by this times 100 will be brought here. Now here we are. We will take a percentage of this. That's what goes here. We'll take a percentage of this. That's what goes here. Remember the last statement I made here. I said gain or loss on right transfer to what? The buyer. So we recognize gain or loss. How do we get it? If this is the right we retained, then the right we transferred is what? This one. So the difference between the carrying value and then the fair value becomes what? The gain or loss. So if the right transferred, the fair value is greater than the carrying value, that means we made what? A gain. But if the fair value is less than the carrying value, that means we made what? A loss. That is what we mean by this final statement here. And we're going to be using a person right now, but that's the concept. So the proceeds comes here. The carrying value we are using to write off the assets goes there. Then we will do workings for the lease, present value of the minimum lease payments. Bring it here. Then we find the difference. That will be the right we have bought, transferred. Then we will use that to get a percentage in the middle ratio, and we will use that to take the carrying values respectively, and then that will give us what? The rights that we will transfer, whether we made a gain or we made a loss. So these are the things you must understand about sale and leaseback. So in the question, if it is not a sale, you go with this. If it is a sale, then the workings becomes another thing. So let's look at the two questions we have there, because that will guide us on these principles. So sale and leaseback, 1. Apple required funding. So even the way the question is structured quickly will tell you about how you go. So Apple require funds to finance a new ambitious rebranding exercise. Its only possible way of raising funds is through the sale and leaseback of its head office for a period of 10 years. So the lease term here, so we're dealing with Apple, is what? 10 years. They want to sell and lease back their office for 10 years. The lease payments of 1 million are to be made at the end of what? The lease term. So when is payment supposed to be made? At the end. At the end. So the minimum lease payments, 1 million per annum. The current fair value of the building is $10 million and the carrying value is $8.4 million and the interest rate implicit in the lease is 5%. So the fair value is 10 million and the carrying value is 8.4 million. So if we are doing this, the fair value 10 million is what will come here. And then the carrying value 8.4, that's what will come here. Then let's go. Advise Apple on how to account for the sale and leaseback in its financial statements if the office building were to be sold at the fair value of 10 million and A, performance obligations are not satisfied, or B, performance obligations are what? Satisfied. So what do we do? A, performance obligation not satisfied. Meaning what? If performance obligation is not satisfied, is it a sale or is not a sale?
It's not a sale.
It's not a sale.
Yes.
So if it is not a sale, what did you say we do?
That one, the seller continues to organize the asset.
Good.
And then organize the financial liability as the process.
That's it. So what do we do in their books? All we do is that since it is not a sale, we don't think about anything. They will still continue to work. So Apple continue to recognize the assets, but recognize a financial liability of what? $10 million. Are you getting the idea? Now, that will be the initial recognition. On subsequent measurements, you have to pay interest because loan is not free. True or false? True. So we charge annual interest at 5% on what? The fair value on the 10 million that we received. So every year, what will be the interest they will be charging on the loan? 5% of 10 million. What do we have?
500.
500,000. So 0.5 million. So every year in the income statement, they will charge 0.5. Then every year, they will continue to what? Depreciate their assets. And then it goes away. Do you get the treatment? So since it's not a sale, we're not going to be doing much. They just recognize the financial liability and then they will charge what? Annual interest. Then they will continue to recognize the assets in accordance with IAS 16.
Yeah.
Let's go to the B, which is where the workings is. Performance obligation is satisfied. So if performance obligation is satisfied, it means it is a sale. What did we say the company does?
First of all, they recognize the assets.
De-recognize the assets and then recognize what?
The sale of the fair value.
The sale of the fair value, and then we also recognize a lease liability, isn't it?
Yeah.
So what will be the lease liability here? LL. How much are they paying every year?
Every year.
1 million.
1 million.
Right? So if they are paying 1 million, how much are they going to be paying in total? We were not giving an annuity factor here. So the thing you were talking about. So you're not giving an annuity factor, but let's see what it has. We're going to get it. So 1 million times 10 years. That's going to be how many years? That's going to be 10 million. Remember what? That's going to be 10 million, right? 1 million times 10 years, 10 million. Yes. But we need to bring this to present value. So present value of the minimum lease payment, we could do the calculation ourselves. So the annuity factor, 1 over what?
1 over 1 plus R.
1 plus
R.
R exponent
R.
N.
Yes.
Exponent N. So how many years are we dealing with?
10 years.
So 1 over 1 plus 0.05. So 1.05 exponent 10. So give me an answer. So 10 million times, I think I had the annuity factor directly here.
0.6139.
Let's see. I think I had it direct in my slide.
So the
What did you get?
0.6139.
0 point. Okay, no, this is a present value calculation.
Yes.
This formula is a present value. The annuity is some Basel formula.
It's a long one.
Long one. So let me give you the rate here. Let me give you the discount factor. Maybe add it to the question. Take discount factor at 5% to be. Take discount factor at 5% to be 7.8%. 722. 722. 7.7. You got it? Okay. 7.722. So let's multiply. 7.722. This is a present value, so it won't work here. So let's go. Let's see how much we get. Okay, we will actually get 7,722,000. Am I right?
Yeah.
So that becomes what? Our lease liability. 7,722,000. Make sense?
Yeah.
Now, if it were not sale and lease back, we would have just, with this 772, we would debit what? Right of use and credit what? Lease liability. But because it is a sale and lease back, remember what I wrote here? I told you that the right of use should be recognized as a proportion of what? The previous carrying value of the underlying asset. And no members are table we have account. Are you following the picture? So let's go. So let's put the fair value here. Let's put a percentage in the middle. Then the carrying value will be here. So what's our proceed? 10 million. So 10 million. What's the carrying value of the assets?
824.
So 8,400,000. Now, what is the right of use we have retained? That would be the same as what? The lease liability. How much? 7,722,123. So the balancing figure will be right of use transferred.
Okay.
Are you getting it?
Yes.
So let's do the arithmetic.
22780.
You like this?
Yes.
Okay. So that's the first aspect.
Yeah.
Then we get a percentage. So what is the percentage of all? So this divided by this times 100. That is something like 77.22%. This will be like 22.78%. I don't know if I'm right.
The 22.78, yeah.
And then this will be 77.22%.
Yes.
So once we have that, you take 77.22% of this figure.
Yeah.
That will be the right retained.
64
86
480.
Then 22% of that, 22.78%.
That is 191.
191.
I just look at the difference.
Okay, yeah.
191
191
3520.
3520. So what did we say? So now we have to find out gain or loss on what? The right we have transferred. That was the last principle I mentioned under the seller.
Yes.
So if this is the right transferred, this is the fair value of the right. But this is the carrying value of the right. So is it a gain or loss? It's a gain.
Yes.
So gain on right of use transferred. So let's get a difference. 22,78123 minus 1913520.
364480. 364480.
That's it. So what will be the double entry for these things? We said number one, we debit right of use, not with this figure, but with what?
Okay.
That was the principle we said. You recognize right of use as a proportion of the previous carrying value. Do you get the language there? As a proportion of the previous carrying value in the underlying asset. So the right of use we're going to be debiting is this figure. 6486480. Then, remember we said we did recognize the asset, but we'll credit the lease liability with still 722,000. Does it make sense?
Yeah.
Then we will again credit the assets, property, plant, and equipment, to derecognize it at what? The carrying value, 8,400,000. Then the proceeds we had, what will be the treatment of the proceeds? We got 10 million, isn't it?
Yeah.
So we will debit cash or bank with the 10 million. Then we will credit the income statement, profit or loss, with the gain we had here. 364,480. Does it make sense?
Yeah.
So that's how we do the workings. So you've got to be making sure, because if it is a sale, then the workings become different. But if it is not a sale, that one is very simple. So the key thing is this guy, the right of use. So the lease liability would just be recognized as a lease liability, but the right of use should be recognized will be the proportion of the asset that we have retained using the previous carrying value.
Yeah.
So that is it about sale and lease back.